Central banks have run the same interest rate cycle 6 times since 1970. Different crises, different excuses, the same structural shape. Tighten, break something, loosen, repeat. This is not a prediction. This is the archive. 6 cycles, let the record speak. Cycle 1, 1965 to 1979. The Great Inflation. The Federal Reserve kept rates too low through the Vietnam War spending surge. Inflation climbed from 1.6% in 1965 to 14.8% by 1980. The Fed tightened slowly, then loosened whenever unemployment ticked up. The result was inflation embedded in wages and expectations. The cycle ended only when the next Fed chair decided the pain had to stop being avoided. Cycle 2, 1979 to 1982. The Volcker Shock. Paul Volcker raised the federal funds rate to 20% in June 1981, the highest nominal rate in U.S. history. Unemployment reached 10.8%, the worst since the Great Depression. 2 recessions in 3 years. Industrial America never fully recovered, but inflation broke, from 14.8% in 1980 to 3.2% by 1983. The Fed loosened, the bond market rallied, the modern disinflation era began. Cycle 3, 1983 to 1991. The savings and loan collapse. With inflation beaten, the Fed ran expansionary policy through the mid-80s. Cheap money flowed into commercial real estate and thrift institutions. The Fed tightened from 6% to 9.75% between 1986 and 1989. By 1989, over 1,000 savings and loan institutions were insolvent. The U.S. government spent $132 billion to resolve the crisis. The Fed cut. Recession followed anyway. Same shape, smaller scale. Cycle 4, 1994 to 1998. LTCM and the Asian contagion. The Fed raised rates 7 times in 1994, catching bond markets off guard. The tightening contributed to the Mexican peso crisis and Asian currency collapses. By 1997, Thailand, Indonesia, and South Korea had IMF bailouts. Long-term capital management held $125 billion in assets on $4.7 billion in equity. When Russia defaulted in 1998, LTCM collapsed. The Fed coordinated a bailout. Rates were cut 3 times in 6 weeks. The cycle ran on schedule. Cycle 5, 1999 to 2009. 2 crashes inside 1 rate cycle. The Fed raised rates from 4.75% to 6.5% between 1999 and 2000. The Nasdaq dropped 78% peak to trough. The tightening helped deflate the bubble. The Fed cut to 1% by 2003 and held it there for a year. Cheap money recycled into housing. Credit products multiplied. By 2006, the Fed was back at 5.25%. Then the cracks appeared. Bear Stearns hedge funds collapsed in June 2007. Lehman Brothers in September 2008. The Fed cut to 0. The longest run of near-zero rates in history began. Cycle 6, 2015 to 2023. The slowest tightening, then the fastest. After 7 years near zero, the Fed began hiking in December 2015. By December 2018, it reached 2.5%, then cut again as markets wobbled. COVID arrived, back to zero, $9 trillion in Fed assets by 2022. Then inflation returned, 9.1% in June 2022, the highest since 1981. The Fed raised rates from 0.25% to 5.5% in 17 months, the fastest tightening cycle in 40 years. In March 23, Silicon Valley Bank failed, $175 billion in deposits at risk. The Fed loosened its language. The cycle held its shape, 6 cycles, 60 years, the same structural sequence. Every time, cheap money, an asset class that absorbs it, a tightening that breaks the weakest link. Central banks do not set out to create crises, but the record shows they complete the cycle at a high rate anyway. Same pattern, different cast, that is what the archive records. This is market memory.